Good morning, class, and welcome to Friday, April 17th. In this video, I'm going to do some announcements, give you a couple of reminders, um, and then we're going to spend a little bit of time going over the material, some more material in Chapter 13, and close with a demonstration problem or two. So, in announcements, I want to really talk about a couple of things this morning. The one thing that I want you to remember is that we have test corrections that I made available on Wednesday. Your test is available for you to see the results until today at 11:59 p.m. So make sure you get these test corrections in by tonight at 11:59 p.m. Again, the test corrections are due tonight at 11:59 p.m. If you're happy with your test score results, no worries, just you don't have to do it. If you would like to improve your score some, or if you need to, make sure you do those. The next thing I want to remind you about that's due tonight is a discussion that I posted earlier in the week. This is really kind of a communication tool for me, but it also is an opportunity for you to participate in the class and earn some points that are really more about attendance than anything else. So, entering into the discussion this week, I'm asking you a couple of questions about your experience with the test. So, just make sure you get those done and posted, and I'll be grading those as soon as I can get to those, but it'll be early next week. Now, the other thing I want to mention, going back to the modules here, is that we have another assignment due next week. It's on Tuesday, and it's in the module in Chapter 12. It's right here, differential analysis. And again, that is an assignment that's focused on the Chapter 12 material. And once again, just go ahead and go in there and do that assignment before Tuesday, April the 21st, which is next Tuesday. So those are the three assignment reminders I wanted to give to you. I have another reminder for you, and I'm just going to ask you guys to make sure and do your course evaluations. You've received an email by this time where you can go in and do a course evaluation. And it's really important for us to hear from you at this point in the course. And the feedback is valuable and valued, so make sure that you do that. Okay, for today, I want to go back to the PowerPoint that we were looking at when we talked on Wednesday. Now, when we talked on Wednesday, I left with this PowerPoint right here, with this slide, the calculation of the net present value method. And what we did was we calculated the present value factor for costs we're outlaying now. And those, anything that we're valuing now in the current period is always a value of 1.0. There's no discount factor to it because it's something we're actually employing into the project right now. The annual cash inflows that will start in the following year and go for 5 years, that's discounted based on what we would call an annuity, and that means a series of payments that come out of the project, or a series of cash flows that come out of the project. And these are annuities because they're basically the same amount that's paid out each year. Then we would have the project, any additional infusion of cash we have in the project, how far out that is, and what kind of a discount factor we're going to do. So since it's in year 3, we look that discount factor up at 11% and calculate it here. In year 5, we're looking at, and by the way, these last 3 are the present value of lump sums. The only one that's a present value of an annuity is this one, because all the payments are the same and they come in every year. If it's a lump sum, we go and we use a different present value chart. Okay, so I'll demonstrate that to you here in just a bit. One other thing I wanted to mention is the possibility that we would have a series of cash flows that are not consistently the same. Um, and this is really what's demonstrated here. So, for example, in this example of a problem, we have an annual cash inflow in year 1 and 2 of 80,000. Year 3, it drops to 50,000. Years 4 and 5, it goes back to 80,000. And then we start thinking about scrap value of the equipment and the working capital released. Now, what happens if we have an uneven cash flow is that we have to value each year's cash flow as the present value of a lump sum. So if we are looking at the annual net cash inflows for this 80,000 in 1 year, we're going to look at that. Let me go to the chart here. We're going to look at that. We're going to look at that as a present value of a lump sum in 1 year. So we're looking at not annuities. We're looking at the present value of a dollar in this table right here. So if we look at the present value of a dollar at 11% for 1 year, we look at one period at 11%, 0.901. That's the present value discount factor that we use here in this slide. So you're going to do that for each year. So year 2, you do the same thing. You go back to this table and you say year 2 at 11%, it is 0.812. And that's what we use here. Year 3, it's 0.731, and so on. We just keep doing that. If you go back to the table, you'll see that here in year 3 is 0.731 right there. Okay, so that's how we calculate those, all right? And I wanted to kind of mention that because having a cash flow that's not exactly even is always a possibility. We won't be doing many of these, but I wanted to show this to you, or we won't have these kind of problems on the test, although a net present value problem is always a very real possibility on a test, but not of that nature, or not where you have to calculate the cash flow for a period of 8 years individually. So basically, the net present value, what you're comparing are these outflows of cash and the inflows of revenue, or the inflows of cash. And basically, you're discounting those flows. So here, when we look at this, after we've discounted all the cash inflows and all the cash outflows, we have a net present value of $76,015. That means we have a positive net present value, and that's going to be something that we will want to pursue because the return on the project exceeds the required discount rate. If we get a negative return, that's going to be less than the discount rate, and we won't want to pursue that. So one of the very good things about the net present value method is that we really do a detailed analysis, and we do compare it to the rate of return that we require. So I don't want to spend much time with that. So a couple of things that we need to consider. We need to look at, in this chapter, we need to look at one thing here I want to mention is the internal rate of return. Now, I'm not going to do a whole lot of, we're not going to do a whole lot with this. I just want you to know what it is. This could be a conceptual question. The internal rate of return is the rate of return that's promised by an investment project over the useful life. And we compute it by finding the discount rate that will cause the net present value of a project to be zero. So what we're actually doing here is working backwards. Now, that's fine if that's an area that you're interested in working in, and I would encourage you to develop that understanding, but in this introductory course, we're not going to spend a lot of time doing that because the internal rate of return is a method that requires you to find the discount method that will result in a zero net return. So Here it says, and this is an example, Decker can purchase a new machine at a cost of $104,320. That'll save $20,000 a year, and the machine has a 10-year useful life. So what we want to do for this one is find the present value factor for the internal rate of return that is equal to the investment required divided by annual net cash flows. We do that, and here we take this divided by this. Now we've got to find where this 5.216 is. And by the way, this present value factor is an annuity. So if we look at this table that they've reproduced here, it's an annuity table. You're looking for the factor of 5.216 somewhere on this table. So what we find, and you have to have a 10-year period, by the way. So we're looking at a 10-year period where the factor is 5.216. You locate it under 14%, so that means the internal rate of return is 14%. That's really a very difficult calculation to make many times, because what happens is once you calculate this, the factor you generate is typically somewhere in between factors in the table, and it's very, very difficult to nail that down. So what I'm going to say is a net present value would be the preferred method, and basically we will use that approach. So I'm going to leave that with that, but there's one other point I want to make here in these slides before we leave them, and that is this idea of simple rate of return. Here it is, in objective 6, we want to compute the simple rate of return for an investment. This is important, and you should know this. We're not going to focus on cash flows here. What we're going to do is we're going to take the annual incremental rate of return, annual incremental net operating income divided by the initial investment. And by the way, this initial investment needs to be reduced by salvage value if we have that figured in. So the example here is with the daily grind espresso bar that we considered in the first video. These are the facts. It costs $140,000 with a 10-year life. Will generate incremental revenues of $100,000 and incremental expenses of $65,000, including depreciation. What is the simple rate of return? Well, basically what we're going to do is take the net income divided by the investment, and we get the simple rate of return of 25%. The problem here in this calculation is that we're ignoring the time value of money, and actually there's some non-cash items in here, including depreciation. But anyway, the simple rate of return is a very easy calculation to make, and it's something that you should be aware of. It's just the incremental net income, which is the difference between income and expense, incremental income, incremental expense, divided by the investment in the project. That's all I want to do with the PowerPoint slides here in the video. For now, I'm going to move into this demonstration problem that I have uploaded into the course in Canvas. And I'm just going to go right to the worksheet because I've incorporated all this in the worksheet already. So let's take a look at the first one. Allen's Attractions is considering the purchase of new video games to place in its stores. The games will cost a total of $480,000 and have a 3-year useful life and a total salvage value of $4,000. The company estimates the annual revenues and expenses associated with the games will be as follows. You have revenues of $400,000, and these expenses totaling $310,000, and a net operating income of $90,000. So the first thing they want to know is, what is the payback period for the video games? And you assume that Allen will not purchase new games unless they provide a payback period of 2 years or less. So really what we want to do is take this non-operating income here. I mean net operating income, not non-operating. net operating income of $90,000, and we're going to add back the non-cash deduction for depreciation. Remember, if we're interested in cash flows, we're not really going to focus on, we don't want to include depreciation in the calculation because depreciation is a non-cash expense. So we have this annual net cash inflow now. So we have the investment required, and for Allen, it's 480,000. And the actual return is going, or cash inflow, after we disregard the non-cash expense for depreciation, we get, if we just divide these, a payback period of 1.92, which means it will be slightly less than 2 years when those pay back. So this would be yes, we would want to do this. We would accept that project. Now, here, the reason I wanted to cover the simple rate of return, they ask, what is a simple rate of return promised by the games? If the company requires a simple rate of return of 7%, will the game be purchased? Well, remember, in a simple rate of return, we're not focusing on cash flow, so we disregard the impact of depreciation. We take the net incremental income divided by the initial investment of 480,000. And when we divide this, we get 0.1875, which is 18 point, well, rounded, it's 19%, but it's 18.75%. So the answer is yes, we would be willing to accept that. Okay, so that's demonstration problem number 1, and that really is the annual, the payback period here and the simple rate of return here. Those two computations are presented there. The third presentation here, the second problem, but actually the third approach is going to be the net present value. This one I think is a very important approach. It's very valuable. And so we want to look at this example in this problem and identify how we would do this here. So the management of Sonati Company, a wholesale distributor of fashion products, is considering the purchase of a $72,000 machine that would reduce operating costs in its warehouse by $16,000 a year. At the end of the machine's 5-year useful life, it will have no scrap value. The company's rate of return is 5%. So they're going to purchase the machine. Right now, the cash outflow we're going to have is negative. It's $72,000. That's what we're putting out for this machine. And I like to do this formatting like this. So we have a negative $72,000 that we're putting into the machine. We'll have reduced operating costs each year of $16,000, and that's a cash inflow. Okay, so we're going to put that in as a positive because it's a cash inflow. This is negative because it's cash outflow. So the total cash flows for the investment is going to be a negative $72,000 in the current year and a positive $16,000 for years 1 through 5. So now we have to find the discount factor for each period. Well, remember, if we're investing money in the project now, the discount period will automatically be 1. So we're going to put the 1 factor there. And in years 1 through 5, we're going to have to look that up in this table. So we have, what they tell us is we have a required rate of return of 5%. So we're going to use that 5% in the table, and we're going to look at not the present value of $1, but the present value of an annuity for 5 periods at 5%. which you find this factor right here of 4.329. 5 periods at 5%, 4.329. So we come back here and the annuity factor is 4.329. And we're just going to multiply these out to see what we get. We take the factor times the annual cash inflow. And of course, this is just going to be the same thing. It's going to be a negative 72,000. So when we look at this and compare these two, it'll tell us whether we want to take the project on or not. In this case, we won't want to because we have a net present value that's a negative 2,736. What that means is the return on this project will not exceed 5%. So the return will be less than 5%. Okay, then what is the difference between the total undiscounted cash inflows and cash outflows over the entire life of the machine? Well, if we take the annual cash savings, we have $16,000, and we're going to have that for 5 years. We basically just multiply that out and we get $80,000. The total investment here is going to be the 72,000, and that's a negative cash flow. So we put that in there like that for 1 year, so it's going to be the same thing over here. If we just did cash flow without discounting it, we would say let's do the project because we have an $8,000 positive cash flow. But that's undiscounted, and that doesn't factor in the time value of money. So those are the two demonstration problems I want to share with you today. On Monday, I'll be going over the foundational 15 for chapter 13. And again, this chapter will be an important chapter when we get to the final. And we will do a review for that final, much like what we did for the third test. But I have some announcements for the final that I think you will find encouraging and a little bit helpful. So if you have any questions in the meantime, please let me know. I'll be glad to help you out with those. Take care and stay healthy.